Hello everyone. In this video, I'm going to share the step-by-step process to build generational wealth. And this is something that I'm particularly excited about because it's not just about making income and investing, but it's also about making sure it can be passed on to the next generations. So you might have heard of these stats that 70% of wealthy families will actually lose all of their wealth by the second generation and 90% is wiped out by the third. While we all hear about long term effects of compounding and that money keeps growing the longer you invest. So, ideally, there should be enough for everyone. And I'm not saying that you have to sacrifice yourself for the next generation. Ideally, all the investing and all the compounding that you have done will give you money not enough just for yourself but for your future generations. You only have to learn the exact blueprint to manage this entire process really well, right? So there's a lot of reports about the Indian family offices, and you often read about big Indian families, wealthy Indian families, and how they are making these trusts and so forth. And the common man is even not sure how to create a will, which is like a basic legal structure to protect your assets. On the other hand, there are examples of the Rockefeller family who have managed to keep their net worths throughout generations. So there are many things that we can learn from all of this, right? But overall, the path, the blueprint to generational wealth is actually very, very straightforward. On the first step, you have the money, which is essentially you create money, cash flow, income through your skills. So let's say you're the first generation. Let's say you don't have anything coming to you. You develop certain skills which allow you to create value for other people or for other businesses. And via that skill, you're able to create income. So now you have this income which you can use to buy assets. And not just any assets. We're going to talk about the types of assets in a moment. You can buy depreciating assets, which are not going to add any value to you in the future or your next generation as such. Or you can create appreciating assets, which is the next level. Or you can create income generating assets, which is the highest level in the hierarchy. And once you've created this, you are getting income for those assets. Either it's coming in cash to your bank or it's coming in the form of increase in the value of the asset itself. You then have to understand what's the best transfer structure. How do you transfer this and still make the most out of it in your lifetime, right? Like I said, you don't have to sacrifice yourself. If you have heard about the withdrawal rate concept, you can have a huge portfolio and you can keep withdrawing money from that, and your portfolio will still continue to be there at the same level. You can actually keep that concept and extend it so that your portfolio allows for your lifestyle but also for your next generations. And this is something I'm personally working on with my two children, thinking about how to manage this entire structure. Of course, I'm thinking a bit too early, hopefully, but this helps to understand the entire process. Once you know the process, you can make certain decisions in your present, whether you're in your 30s, maybe you're in your 40s. You can make certain decisions now that is going to be helpful to do this process and execute it in the future, right? So skills and mindset transfer, which is of course way more important than just a legal structure, because they can still figure out ways to deploy all of the funds in a certain way that may not be favorable to them in the future. So you also have to transfer the skills and mindset. And this is the path that we're going to look at. So let's start with the types of assets first. Now, there are three different kinds of assets. There's the depreciating assets, which could be motorbikes, cars, fancy furniture, even the products that you use on a regular basis, your electronics. They all depreciate in value over time, and they are classified as depreciating assets. Then you have the appreciating assets, which increase in value over time. So let's say your family owns a plot, maybe you own a land, and you will see that the price goes up. Maybe not by a lot, maybe you didn't build anything on it, but still the price goes up over time, right? We're going to discuss a few numbers as well. Maybe you just bought some stocks and you kept them. There are stories of families where the grandparents or the parents bought some stocks, they forgot about it, now the price has gone up, but they did not generate a lot of income on the way for the people to use. So That brings us to the third category, which is income producing assets. And these assets not just appreciate over time, but also produce income. So it could be a rental property. The value of the property itself is going to go up over time, but it's also going to create income for you. A dividend stock could be another example. In fact, index funds also give you dividends. It's just that they are reinvested back into the index. So you get more units, or you get a bigger folio because of the dividends, but dividend stock will give you the dividends in your bank account directly. I actually prefer the index funds because I don't want the dividend coming into my bank account and then I have to pay tax. I actually think that's not the best thing for the next generations. But someone who's looking for a good mix of, I should get the money now and then it should still keep growing, that's another mindset to think about, right? For me, it's index funds because the money is going to go back into the index, thus helping the future growth of the portfolio. Now, what's the strategy for generational wealth? Generational wealth, I can say that we can split it into 5 levels. And I've thought about these levels which apply to almost any money wealth building. So any money game that you're playing, right? So all of us are playing this game of money, but we are playing at different levels. The most basic level, which I would say level 0, which is not mentioned here, is that you get a job, you get some money at the end of the month, you get your paycheck, and you save some amount of that. Saving money from a monthly paycheck is probably the base level. It's the slowest path to wealth. And that's because you're just saving. Maybe you're not investing. If you're investing, you're probably investing a very small portion, and your upper limit on your income is already set by your job. But as soon as you reach level 1, there is no upper limit because now you grow your active income. This is what I call level 1. So I have not mentioned level 0 here. And, it could be possible that a lot of you watching the video are already on level 0. So that's something that you're already starting on. And there's nothing wrong with that. It's all about how you can go from this level, wherever you are in right now, to level 1, to level 2, 3, 4, and 5. And you will have to go through all of these levels. And at the end, you will be basically generating generational wealth. So level 1, grow active income. You could have a business, you could have a side hustle, you could be a freelancer. Maybe you launch a side project, maybe a product, maybe a SaaS product, maybe an online course, maybe info products, maybe a book. All of these things are possibilities of creating more income outside of whatever you're doing in your full-time job. That's level 1, because this really gives you the upper hand. Let's say you get a job where you get paid 40,000 rupees a month and you start freelancing for a client that pays you 20,000 a month. Maybe you get 2 clients, 40,000 a month, you double your income, right? If you had to do the same thing in your job, you can ask for a raise. You can create more value. So whatever your value is in the marketplace, instead of thinking about, oh, I get paid so less, so I should work less. Instead of that, I'm not talking about working hours as such, but like the output. If you can use productivity hacks and techniques and maybe some AI tools to give more output to your organization, more value to your organization, you can probably ask for a hike as well. But again, I still feel a side hustle or a business or a freelance would still be the best way to grow active income. At least that's what I've done in my journey as well. Now, level 2, building assets that grow. In this level, we are basically taking some of the money that we are generating on a regular basis. So let's say the full-time job plus the side hustle plus all of that income together, we're taking a percentage of that and putting it in assets that grow. So the money that makes money makes more money, right? So you take that money, you put it into assets. So your money is now making more money. So whether it's in equity, if it's in equity, I would just suggest very simple index funds for most people. Just put it in the Nifty 50 up to a certain level. And we're going to talk about the different stages of wealth as well. So up till 1 crore, I think you should not worry about which stock, which fund, blah, blah, blah. You can just put it in an index fund. So Nifty 50 and probably Nifty 50 and a little bit in the next 50 should be enough up till the 1st crore. Gold, a little bit of gold. Indians like to have some gold, and it's also a good hedge against equity, but it's completely optional. Again, up to 1 crore, you may not enter into real estate, but you might inherit it from your family. Like I said, so those are all assets that can grow. This is all level 2, by the way. Up till the 1st, if you don't have a real estate background, if you don't have something coming from your family, then up to 5 CR, I think that real estate is not required. Rental yield in India is super low. You can rent a place wherever you want. It's like a dream, honestly. The country allows you to rent at so cheap prices, yet it encourages you to buy. So if you understand that psychology and you can leverage that by basically renting wherever you want to live and then let your money grow in equity, then you'll be able to hack into the system and, kind of grow your assets faster. But that's kind of a gift in India that you're allowed to rent for so cheap. Now, level three, assets that make money: index funds, dividend stocks, rentals. These are all assets that actually generate income. Like I said, dividend stocks, it's more visible. A lot of people actually ask me, you invest in the index, you're missing out on dividends. That's not true at all. Index funds also pay you dividends. When you invest in the index, let's say you invest in Nifty 50. Now, there's 50 companies in Nifty 50. Where are the dividends going to go? They're not going to disappear, right? So those dividends, you can read further about it, are basically still part of your portfolio. They are, you either get more units, they're reinvested into the NAV goes up. So it's all there, right? It's not going away anywhere. It's just that with dividend stocks, they come to your bank account. Let's say Tata Power pays you 1,000 rupees of dividends. Now you have to pay tax on that 1,000 rupees because that's your income. And now you have to use that money somewhere. So maybe you invest that money again into equity, right? So you pay tax, you reinvest it. You pay tax, you reinvest it. So you're unnecessarily losing out, not just on compounding, but also on tax. So I prefer just index funds that reinvest the dividends. I don't want dividend payouts. Even the mutual funds that I have, none of them pay me dividend payouts. They are all just reinvested. If you want to make money more than dividends, I would say think about passive income streams. Think about online businesses that can generate passive income. Think about side hustles that can generate passive income, which brings us to the next stage, which is level 4, which is assets that make money while you sleep. Now, up till now, we were all talking about active income, but now we are talking about passive income. So, for example, my active income was a digital marketing agency. But as part of the agency, we used to get clients who used to need certain tools. So let's say we used to work with e-commerce brands and they used to build their stores on something called Shopify. Now, Shopify partnered with us, or essentially we partnered with Shopify as an affiliate. And whenever a brand used to buy the Shopify subscription from our link, we used to get paid every single month as long as the brand was using Shopify and we were active affiliates for Shopify. So this is passive income. This is a very good example of passive income because you're not recommending a random software. You're recommending something that you're already a partner of. So something that you already use. So for example, I have videos on my channel about Singapore Company Incorporation, and I actually use that service to incorporate my company in Singapore. And I think it makes a lot of sense to save tax by incorporating the business there. So I tell people you can also do this if you want to. I mean, here's all the data, here's all the information, and then you can make a choice. But if you incorporate using my link, of course, I get a commission out of it. That's passive income because I already made the video. And now I can get some income. Again, YouTube right now is not my main source of income by any means, but there are other passive income sources because I have growth marketing courses. I have my, marketing clients that I also refer to certain tools. We have email marketing software that we are trained on, our team is trained on, and we refer that to our clients. So those are all counted as passive income, right? Level 5, assets that make money for your children. So now we can extend these assets. We can build a brand around it. We can build a business around it. We can teach our children how to run different parts of the business. We can hire them as interns. We can give them skin in the game. These are all ways that the children will inherit the assets and not the cash. As soon as they inherit the cash, it's going to start going away. But when they inherit the assets, they have a much higher probability to keep growing. Imagine this. I have to make so many videos just to make people understand that they must invest, for example, right? But I cannot recommend it. I can only say this is what I do. But simple things like people putting their money in classes, asset classes that don't even beat inflation, they have to learn it from YouTube videos and, blogs and AI tools and Google searches. Like they have to learn so much. So you can't really assume that your children are suddenly going to take cash and then keep growing that cash by default. They are most likely going to burn that cash, which is what happens by the second and third generation. When you had to invest so much time and energy to learn that cash will die over time if you don't do something with it, then don't expect your children to know it as soon as they get the wealth transfer from you, right? So that's level 5. Now let's break down each level. Level 1, the hustle. You want to increase your active income in this level. Your mission should be to start a side hustle, freelance, or launch a small business. Now you've proven your ability to generate money on your own terms. If you haven't done it yourself, don't expect that the next generation can do it as well. Now, you don't have to become Tata, Birla, and all that. Like, I'm a simple person. I have a small business. It's actually a very small business, but I'm able to generate enough value so that I have early financial independence and I also can pass on the value to my next generation. So don't think that this is something reserved for the best, most gifted people. Like, I'm not the most gifted entrepreneur or something. I just have a lifestyle business, right? It's a simple SOP driven process. Now, level 2, the investor. The objective now is to build the assets that grow in value. So invest in assets like stocks, real estate, gold. All of these investments appreciate over time. Now your money is going out in the world and making babies, right? It's making more money. So your money goes out and makes more money. Level 3 is the money machine, where the assets also produce regular cash flow or income. So now you're acquiring assets that pay you, such as index funds, dividend stocks, rental properties, a profitable business or a brand. I would say at the top of the hierarchy is a brand, right? So for example, Tata Sons, it's a brand. We all respect a certain brand, and now they can do whatever business that they want because the brand value is such. But it's very hard for the common man to put a number on a brand, and hence it's just out of reach for most people. But rental properties, dividend stocks, index funds, these are so much in reach. At least under 5 CR, you can play with 0 to 5 CR. You can, with any amount of money, you can play with index funds and dividend stocks. I would still recommend index funds, but that's up to you. Do your own research. Beyond 5, like in the 5 to 10 CR range, you can play with rental properties. Or you could, if you have a property in your family, or if you inherit something, then you have an advantage over the others. Again, it's not about a competition, but then you don't have to wait for that 5 CR by building your business and growing your business, and you can directly tap into the rental properties advantage, right? So now your assets are now making money and earning money for you. Level 4, passive income. Create money that makes money while you sleep. Now, again, let me stress on this. There's nothing such as passive income, like this is basically kind of a false statement, but then it's more passive than other sources of income. So if you were to draw a line, make a spectrum of active to passive, then you can say, okay, this kind of income is somewhere here, right? So for example, if I run an agency, I get a client, it's super active. As long as I'm working for the client, it makes sense. I make money. If I stop working for the client, it's not that I'm going to continue to make money by magic. Now, let's say I hire a team, I give them the SOPs, they do all the work. It's active for them, but then it's slightly more passive for me. So now I'm moving a little bit more on the passive scale. But let's say, for example, I tell my clients to use a certain software, which is good for them, that solves a problem for them. Now they're paying, let's say, $100 a month for the software. I'm making $20 a month, 20% commissions every month on that. Now, this $20 a month is super passive. It's completely on the passive scale, as long as the client uses that software, right? So when your passive income covers your living expenses, you have achieved financial freedom. Again, this is just one path to financial freedom. Another path to financial freedom could be when you have so much money that you can withdraw a certain percentage of it and don't really know what's happening, and your portfolio just keeps growing. So for instance, I have made a video about this, that I want to hit 100 crore portfolio, hopefully in my lifetime, but definitely going to hit 100 crore portfolio, whether in my lifetime or not, but I'm definitely going to hit, like, the maths just makes sure that I will hit 100 crore portfolio. My current portfolio value is around 8 CR, right? 8 to 9 CR. It varies somewhere between that range. I am 35 years old, and I think I will hit 100 crore portfolio in my lifetime. That's one way to achieve financial freedom. I say, okay, 10 crore is my enough number, and I've made a detailed video on how to find your enough number, how to find your financial freedom number. But mine is 8 crores. This is not the FIRE principle. It's based on multiple calculations that I've done, and I've covered that in the video as well. But if I have 8 crores in assets that appreciate, which for me mostly is index funds, then I will be able to withdraw a certain amount for my living expenses and still never have to worry about money ever again. If it's 100 crores, let's say I withdraw a few crores a year, I don't have to worry about money. So that's just one way to financial freedom. Another way is your passive income is enough, as long as you can rely on that passive income. So there's different paths to financial independence as well. More on that on the enough video, which I've already created. But yeah, wanted to just mention that in level 4. Now, level 5, the legacy. Now you create generational wealth for your family. So you design a financial plan that will continue to grow and provide for your children. So you've secured your family's future. This is the stage that I want to work on now. And I'm going to make further videos on this as well. So this is going to be the sort of the index video. Once you go through this video, let me know in the comments of specific parts of this video that you enjoyed so I can make more videos on those parts and I can deep dive into this further, because generational wealth is going to be my plan in the works for the next few years, right? So do subscribe to the channel, turn on notifications so you can get the future videos, and leave a comment about the topics from this video that you want me to cover more on, okay? So what are the steps to build this legacy? Step 1, play the money game yourself. If you think I'm going to inherit money from my, let's say, ancestors and then pass it on and that's about it, I'm going to skip the first steps just to the last step, it's not going to work out, because you cannot transfer what you haven't built, right? You can inherit something, you can build on top of it, and then you can transfer it, because you'll play the game, you know the rules of the game, you'll know how to win. Only then you can teach other people how to win, right? So play the money game. If I did not build my enough portfolio of $1 million, I wouldn't make these YouTube videos, right? I'm not making Gyan videos. I'm basically sharing my personal journey. If I learn something on top of my personal journey, I say, this is what I'm learning, right? Generational wealth, for example. I haven't built generational wealth, but I'm learning how to build generational wealth. So I'm sharing what I'm learning. But what is the base on which I am building this, that I've already achieved all of the levels before that? Right? So I've achieved my enough number, I'm financially free, I've built businesses, I've made active income, I've made passive income, I've done everything else. And now what's left is generational wealth. If I'm successfully able to build generational wealth, I will not be able to make videos about building generational wealth, because I may not exist back at that point of time, right? So I need to document this journey so that people who are also in the same process, something that they're building for future, can also learn from this, right? Second step, create income producing assets. Third step, learn how to pass them through the generations. The legal way of passing them, the best way of passing them, is also very important, right? Now, we spoke about the depreciating assets, appreciating assets, and income producing assets. And I told you to focus on income producing assets. There's different kinds of income as well that you can produce. You can produce income that hits your bank, like I said, or you can produce income that goes back into the investment. Even if it hits your bank, you do have an option to send it back into the investment. I also mentioned that you have to find the balance between you enjoying your lifetime and your children enjoying theirs. Somehow, I don't know why, but when I watch online content, there's always one of these two things. People say, I'm gonna die with zero, for example. That's one school of thought, that I'm gonna just burn everything, use all the money. On the other side, they say, I'm just gonna live so frugally. I'm not gonna, buy this thing because I want my children to get money. I think you can balance both. I think both can be done. That's the magic of compounding. That's the magic of income producing assets, right? Which is why I focus on this path to generation wealth. Now, again, this is not the only path to generation wealth, but for me, income producing assets is the best way to generation wealth. If you want to balance your own joy and fulfillment in your life and also your children. Of course, if you're a simple person, if your needs are less, it's going to be easier for you to pass on more, just like me. But if you want to enjoy certain things, you should be able to make a plan that allows you to do that as well. So one thing I do want to mention is I'm not against buying like fancy furniture and some things you like. For example, like I like LED lights. I buy a lot of small LED lights. I like small lamps and this and that. They're not expensive because I live here in Vietnam and, we have good access to Chinese products. So nothing is expensive. But at the same time, if you enjoy something which is a luxury item, you should still be able to enjoy it and pass it on. That's the whole point of why I'm focusing on these income producing assets, right? So this is what happens if you don't have a generational wealth framework. What happens is you build wealth, you are the entrepreneur, then you maintain wealth, maybe in the next generation, and then you squander the wealth in the third generation, right? We don't want that to happen. We don't want 70% of the wealth that we generated to get lost in the next generation and 90% the generation after that, right? Enter income producing assets. Don't leave money, it gets spent. If you leave assets, it keeps growing. So instead of leaving 1 crore in cash, you could leave an index fund portfolio. If you had put 1 crore in the index fund portfolio, maybe for a few years, it would have already grown, or a rental property, which ensures money flows every year. Those are simple examples, but there's more, right? So what are the numbers? What do the numbers tell us? The CAGR index growth in India is around 12 to 14%. This is a blessing that we are in India and we have this advantage. Of course, we should still diversify with, let's say, the US index and some assets outside of India. And as you go up to the levels, which we'll talk about in a moment, you will see what is the best time to diversify into those geographies as well. For example, me personally, I invest in the US index through a Singapore company. I have a business in Singapore. I hold multiple currencies through that business, but I'm majorly invested in the Indian index, given the fact that 12 to 14% kind of a growth rate is something you can expect only in this particular index. Now, you can watch my videos where I've disclosed my entire portfolio. My XIRR over the past 6 years, it keeps varying, is around 16%. And that too I saw because people keep asking. I'm a very simple index investor. I invest in the Nifty 50, the Next 50, and Midcap 150. Those are my top 3 holdings on my portfolio. The overall portfolio value is going to soon hit around 5 crores. And outside of that, I have other assets, apartments in Vietnam, a little bit of gold, some cash, my business accounts, my Singapore company holdings, all of that adding together to somewhere between 8 to 9 crores of net worth, right? That's my portfolio breakdown if you were curious, right? Now, dividend yield 1 to 3%, rental yield 2 to 3%, could be more. Of course, there's 4%, 5%, and so forth. 79% commercial, REIT is around 6 to 7%. If you build a digital product, the margins are around 80%. The reason why I mention this is because oftentimes a lot of people spend a lot of their time thinking about 1, 2, 3, 4, but almost never think about income, right? So digital product margin is around 80%. Digital agency margin is around 40%. That's the business that I run. That kind of growth you cannot get by any of the investing. If you're a beginner and if you're spending your time on YouTube, for example, learning about investing from personal finance gurus, I want you to switch that and maybe learn about AI, maybe learn about specific skills, maybe design, maybe marketing, maybe writing, any skill that can create value in the marketplace. That's going to help you get 100, 200, 300% returns on a year. And then you can just park that money in the index. Like that's something that not a lot of people talk about, but that's going to give you much better returns than any of the stock picks that you will get from these stock trading gurus, right? Stay away from taking loans, stay away from FNOs and all of that kind of stuff. Just focus on creating value in the marketplace. You make money when you create value. And when you create value, you also get brand value in return. We all as people also have a brand value. So for example, I get these emails from crypto platforms where they say, okay, you just have to mention 10 seconds about our platform on your videos. You have a trustworthy audience and your audience trusts you a lot. You have a high value audience. They know this from my channel. Even though the subscribers are low, the quality is very high. And they say, just mention 10 seconds. And I say, the reason why I have this quality audience is because I don't do these brand deals, especially the ones that I'm not part of. Like it is not in my value system. I don't invest in crypto. I don't buy and sell crypto. I don't use your platform, so I cannot do it. But it's the value that they have associated with me where they can pay these crazy amounts even at this subscriber count just because they know that the quality of the audience is good, right? So brand value grows exponentially. That's something you have to keep in mind. Whether you want to use it or not, that's up to you. Like, for example, personally, I wouldn't use it. But for example, for my agency, Mapplinks, which is a brand, I still keep getting messages on my LinkedIn profile, on my email about project requests from clients just because Mapplinks has done good work, right? So it's been around for 12 years. We've done very good marketing campaigns. We have marketing campaigns that have broken world records. So all of those case studies are on our website and people come through those and people come through my LinkedIn profile and they ask me, can you take up clients? Again, it's a different story that I'm not taking any active projects or clients this year because I want to focus on parenting. But if I was taking up, I always had the opportunity. And that's something that you cannot put a number on, and that's your brand value. Okay, now that we've spoken so much about money, it's also important to remember that it's not just about money. You have to pass on the financial education that you've learned. I always tell people, if you watch my videos and you don't have the time or money or energy to invest or to do any of the things that I've mentioned, but you take that knowledge and you take that education and then you're able to use it whenever it's applicable in the future, that's kind of the best ROI that you can get. So the financial education, the habits, just the habits to invest consistently, to do something which is better for the long term, to avoid instant gratification. These are all good habits that you can build and pass on to your next generations. You can teach them how to run a business. So I was listening to a TED talk by someone who said, I'm just going to teach every grandchild that I have
one part of the process of the business based on their best aptitude and their interest. And then I'm going to leave the business to them to make money under a trust contract of how they would get the business returns. Now, that's a very interesting way to put it, but basically that summarizes what I'm talking about here to generate generational wealth. And that's a great example of that. Another way is to have them as interns, teach them how to invest, pass the mindset, right? So let's talk about the types of income producing assets. Now, type one is going to be your financial assets. This is your core portfolio of income producing assets. Now, imagine you're building a portfolio of income producing assets. This sits at the core. This is your index funds, your ETS. Your growth comes from the capital appreciation. Also, your dividends are reinvested, like I said. So you're getting the benefits of compounding from all angles. Your dividend stocks and dividend funds are the ones that pay you regular dividends. This is kind of a balance between growth plus getting money for you to spend. But if you've actually built a business, you can get money from there as well. So you can pay yourself from the business. Then you have your bonds, government securities, not something that I'm a big fan of, but they also have options where you get fixed income. The second one is real estate assets. At a certain level, you might want to add real estate to your portfolio so you can buy and then rent it out and then get your monthly cash flow. Again, rental yield, not the best in India. I have 2 apartments. Both of them are in Vietnam. I've not got something in India yet. But yeah, that's something for you to figure out, like what's the best geography you can invest. I know a lot of people who are investing in the UAE who are Indians, for example. So they buy real estate in UAE. They get around 8% rental yield on that. So that's something that you can think about. If you're starting at a smaller ticket size, REITs is something that you can look at. Airbnbs, vacation rentals, commercial real estate, and Goa and so forth. Those are things that will increase your rental yield further. There's also agri-farm projects like managed farms and so forth that you can look at. If you find something trustworthy, that can give you a better rental yield as well. Type 3, my favorite, is business assets. So you own a full-scale company, you own a side hustle, you get your income through your profits and your dividends. We are not talking about a VC-funded startup as such, because that's like a different level of hustle. Like, for example, I don't want to take that stress. So I have a simple business that has clients. When I don't want clients, I don't have clients, right? So it's a lifestyle business. That's what I call it. It's a freedom business. So I call this freedompreneurship, where you're not invested in by VCs and not answerable to them. Otherwise, you basically just have another boss. That's a different path. Like, I don't want to make a dent in the universe or anything. I just want to create value for a few businesses, and make money in exchange for that. It's very straightforward, right? Digital businesses, content, digital info products, SaaS. Remember that digital businesses are going to scale faster and give you location freedom, right? Type 4, intellectual properties. So for creative people, music, books, software, patents, increasingly, growing in India with creators, the creator economy and startups. Building a brand name, like I said, is again an asset, and that can generate a lot of income for your next generation as well. Now, let's talk about the stages which I've been mentioning, right? So how do you start building generational wealth? Stage 1, less than 1 crore. If you're on your path to 1 crore, make sure that you watch 2 of my videos. One is about why net worth explodes after 1 crore, so you get motivated to get to 1 crore. And the second is how I would make my first crore if I had to start all again. And the second is how I would make my first crore if I had to start again, because then you will learn the blueprint of what I would follow. So the focus here is grow your skills and income. The assets that we are, going to invest in is just index funds. And we're going to avoid buying expensive cars, luxury gadgets, anything in terms of transportation. Just get something that gets you from point A to point B. And even better, just avoid going from point A to point B. Just like stay in one place as much as possible. If you have to go for opportunities, use the rental economy, tap into the rental economy, take a taxi or whatever. But the more you save here, the better it is for your long-term growth. Because this is not the stage that you want to enjoy all your money. This is just a stage you want to build the fundamentals for future growth, right? So you're not building complexity here. You're just building consistency. Track your net worth. This is another thing that will help you. So I started tracking my net worth at 12 lakhs. And then you can see the compounding kick in. 2025 Q1, I was at 8.5 CR. So tracking your net worth will give you a good idea. I have a separate video on this where I've also given my net worth tracking template that you can use. You have to try to create a monthly surplus and then put it all in the index. That's your main goal. Stage 2, 1 to 5 crores net worths. Now you can diversify and add more cash flow. So before even diversifying your investments, Because I know a lot of you might be saying, oh, I have so much money. I need to learn about investing. I need to know what are the best funds, what are the best large cap, mid cap, small cap, what are debt funds, where do I park my money for so much, blah, blah, blah. But actually, most importantly, you try to diversify your income stream first. Add another cash flow stream. That's going to give you much more benefit than spending hours learning about the best mutual funds, right? The most popular topics are like, what's the best small cap fund? What's the best mid cap fund? It's still better than which stock to buy today kind of a content. But people are at different levels in the hierarchy. There's at the base level people who are saying, okay, which stock to buy today? And the excuse that they make is, I don't have enough money to buy just like index and forget about it. So I need to make money. Boss, unless you're a professional stockbroker, you cannot consistently make money by trading, because you are majority. Most likely you are the 90%. 90% of people lose money in trading. And the rest, they don't make money, they don't lose money, right? So there is very few people that consistently will make money trading over the next few decades. And they pay a huge price for that. And it's not scalable, right? So if you're looking at like 3 people in the world and then trying to be like them, it's definitely going to be much harder than, for example, me. I just say I'm a simple person. I'm looking at how most people can make money. Most people can start a services business by developing a skill. Most people can invest in the index and beat inflation. Most people can stick to the index for the longest period of time versus a mutual fund even. Forget about stocks. Every year they say, these are the best mutual funds. So if you invested in the 2024's best mutual funds, what are you going to do in 2025? Are you going to sell out, kill your compounding, pay your tax, and then invest in the top funds of 2025 and then repeat that in 2026? That's the sure shot way to kill your compounding, right? So most people can build a simple revenue stream. Most people can buy index funds. This is what I've done. I've basically done a lazy kind of investment strategy because I'm not smart to pick stocks. And I'm smart enough to build a business, take that money, put it in the index, and keep doing that on repeat. Like that's exactly the best, I think, easiest blueprint that majority of people can form, right? So that's stage 2. Stage 3, now you've crossed 5 CR. This is where I would say international exposure becomes important. You have some diversification in the international markets. You have rental properties. Maybe 1 or 2 rental properties would be good at this stage. You have some US, index. I personally have a Singapore structure because it helps me invest in the US and also diversify the currency. Also, tax avoidance strategies become very important. So I have a video on the ways that I save tax and avoid tax. Definitely watch that video as well if you're in this stage. Even before that, you can start to deploy simple tax avoidance strategies. You may not need like a complex framework, like multiple businesses outside India and so forth. But at this stage, you can afford to have that framework, right? So stage 4, 10 CR plus. This is where I'm going to, basically be headed towards very soon. And the assets, I say family office, and you don't need a family office as such at a 10 CR to let's say 20, 25 CR kind of net worth. You don't need it, but you need something of that style. So you need a mixed, diversified investment portfolio. That's the first thing that the family office looks at. Then you need a trust, something like an HUF could work, or a holding company that allows you to build a legal framework for succession so that the money is not lost. And there are certain rules on how the money will be passed on. A very simple common man example version of this is a will, right? But at this stage, we are looking at trust, HUF, holding companies. Those are the different ways that you can structure the succession. I think that topic deserves like its own video. And you need income sources. And the reason I say lower risk income sources is because you want them to survive through generations. So simple example, but you want to build something the wealth survives generations. As per me, a brand is the best example. So if you build a brand, it's likely going to survive. It can adapt through different stages. For example, when I started Mapplinks, it was doing websites, right? Because I started Mapplinks in 2009. And the only thing we used to do that time in marketing was websites and SEO. Then we started doing social media. In fact, we were the first agency in India to run Twitter ads. And because that's the time that Twitter ads actually came, and now it's X. We did Meta ads. Back then it was Facebook ads. Then we did e-commerce, and there was this e-com boom in the US, we did e-com US, we did SaaS. Earlier, we used to do B2B in India as well. So you can adapt it. Now we are building some AI products, for instance, right? So the wealth will survive through generations when you have these income sources, right? Now, the structures to pass wealth to the next generation. The wills are the basic legal framework for inheritance. I think most people understand this. You still need a legal process to do a will. Then you have the HUF. If you're applicable for this, it creates a separate tax entity. So you can save tax in the present as well. And then you can have the succession rules, but not as much control as you can get with a trust. Now, trust is great to protect the large assets. Now, if you read about the Rockefeller case study, you will see how they use the trust really well. So this provides much more control over how and when the wealth is distributed. This is what I think I would recommend for most people. In the 5 CR plus, you can start thinking and learning about the trust. And in the 10 CR plus, holding companies would make a lot of sense. And you can even think about whether your holding company will work alongside a trust and how the two will communicate with each other. Will the holding company be in India or Singapore or UAE, one of those lower tax geographies? Will the trust be in India, for example, and the holding company be in Singapore? There's a lot of questions that we can answer there, but that's a personal point, right? So it depends on what assets you've built, how much you have, who are the people who this is going to go to, how many people are involved. So all of those questions will allow you to reach the best setup of the legal framework, right? So the next comes, apart from the legal framework, you also have to teach the next generation. So the assets without knowledge are a waste. You have to pass down not just the wealth, but also the financial education. You have to share the family values. You have to teach patience, long-term investing, discipline, and of course, your business operations as well. Finally, the mindset transfer. You have to combine the money plus the mindset plus the systems. Right now, for example, even if I don't think about this as my children, my team is running my business based on certain SOPs and systems because I've passed on the systems to them. And the mindset pass on, of course, will take time because I don't have that much engagement with the team that I could have in my children because I'm with them. So being present with your children will help you to transfer this mindset. So if you don't transfer the mindset, they can't do much with the assets. Now, all of that being said, I know there's a lot of content in this video and there's going to be more in the upcoming videos as I break down these individual topics. So please comment on which topics you want to hear more of. But the biggest gift you can give your children is the right values, principles, and mindsets. And this really matters more than money. I would say all of this kept aside, if you could just transfer good models and values, and they can use those principles to build their own life, that should be good enough as well. So I want to leave this video at that. Even money is a value game. I always say you make money when you create value. You grow assets when those assets create value. Your assets grow in proportion to the value they create. They just don't grow by itself. The percentage returns that you see, it's not just magic. It's that money going out in the world, whether through a business, through a stock that you buy, that they create more value. So money fades, but value stays. That's all for this video. I'll see you in the next one.